Welcome to KNN. KNN is brought to you by Bob Knakal, Chairman of New York Investment Sales at JLL.
Hi, I'm Jon Hageman, Managing Director at JLL. Welcome to KNN. Today I'm here with Bob Knakal, Chairman of New York Investment Sales, and today we're going to talk about the state of the multifamily market in New York. So Bob, there's been a lot of profound changes in the multifamily space over the last couple of years. Why don't you just take us through where it started a couple of years ago and then we can get into where we are today.
Hags, it's been really fascinating to see what's happened in multifamily for decades. Going back to when I started in 1984, the multifamily market was always the bedrock of New York City investment sales. There were always more investors that wanted to buy multifamily, more lenders that wanted to lend on multifamily. There are more multifamily buildings than any other type of building in New York City. And it's always been the most stable market that we've had. And then we started to see the political headwinds get very significant a few years ago. A lot of changes to the laws, the rules, regulations, everything seeming to make it more difficult for folks to make profits in their buildings. So probably of all the trends that I've seen over the last several years, probably the most disheartening has been the fact that so many of our clients who for decades have only bought New York City multifamily buildings are buying around the country now. Probably 90% of them are investing in other cities. That has been something that is a huge thing that we've had to contend with. Secondly, I think the policy changes, particularly the changes that went into effect in June of 2019, created a disincentive to deploy capital into the market for some folks. And that has also been a very disappointing thing that we've seen. Those are the two biggest things that have impacted the market very fundamentally.
So you mentioned policy changes. What are some of the specific ones that you're talking about?
Right. Well, in June of 19, they basically eliminate or reduce very significantly the ability for owners to extract upside potential from their properties. I go back to the 70s when, I always use the illustration, the Bronx is burning during the 1977 World Series. 1977, 14% dilapidation rate. 14% of the housing units in New York City were uninhabitable because of their condition. So the city devised the individual apartment improvement program, the major capital improvement program. Those programs incentivize the private sector to invest hundreds of billions of dollars in the housing stock, such that the dilapidation rate today is 0.04%. So it really created a big incentive to invest in the market. Both of those programs were significantly marginalized during the rent law changes in 2019, and really to the detriment of the quality of the housing stock because there's no incentive to invest today. And so that is also leading a number of our clients to want to buy around the country. But the good news is that there are new folks that are emerging that want to buy properties in New York. So clearly, if somebody wants to sell, there has to be a buyer. So that has been a positive thing that we've seen. A lot of new folks emerging, wanting to buy, raising funds to buy. And I think a big driver of that is that we've seen, because of the exporting of capital and just the dynamics generally in the multifamily market across the country, we've seen cap rates actually for the first time ever drop and are lower outside New York than they are inside New York. And that's also creating an incentive for investors from around the country to come and invest in New York. So on the demand side is there with a lot of new faces, a lot of new companies. It's remarkable how many folks I'm calling saying, hey, would you like to have lunch? I see you bought this, you're buying this, and getting to meet new folks who are becoming active. But, there still are a lot of issues that the multifamily market has to deal with.
Let's talk about some of those issues. What specifically are you referring to?
Well, the three big topics on the mind of all multifamily market participants today are what's happening within the emergency rental assistance program. Of the $46 billion that the federal government has allocated for rental assistance, $2.4 billion was allocated for New York. Only a small fraction of that has actually been deployed and gotten into the marketplace. There's also a question about what the efficacy of this program is going to be, simply because you can get up to 12 months of back rent, but then you can't evict the tenant for 12 months if they don't pay. So is the government just basically paying so that the tenant can stay there for 12 months rent-free? How is it going to work? There are a number of issues, number of concerns about that program, how it's being implemented, what the benefit really is going to be to the property owner, the tenant, the city, et cetera. Two other big issues that are going to be discussed in the next session are good cause eviction, which is essentially universal rent control, which there seems to be a lot of momentum for. Certainly there's a lot of momentum around the country around that issue, and I think that is something that the industry is very concerned about today. The second issue that is likely to come up in the next session is this whole issue of being able to create new first rents with new apartment configurations, combining units, separating units, adding to a unit, subtracting from a unit. In the bill that Kavanaugh proposed in the last session that didn't succeed, was trying to eliminate the ability to get a rental increase for doing that. That has been a big incentive for the industry to create new units, enhance units, renovate by changing configuration. It seems like every tool that the industry has to try to extract upside potential from properties is being marginalized or eliminated. And so those are things that the industry is going to look at very carefully, is watching very carefully to see how that's going to impact the market moving forward.
What about the current rent guidelines board increases, Bob? Let's talk about what those are.
Yeah, currently there are increases, which is positive. 1 year.
Not zero?
Well, one year leases, the increase is 0 for the first 6 months and then 1.5% for the next 6 months. If you give a 2-year lease, it's a 2.5% increase from month 1. So that's a positive thing. There are very few rent-controlled tenants left, or rent-controlled units left in the city. If a rent-controlled tenant leaves, you can get a new first rent at the market level, but that rent will become a stabilized unit. So again, there are increases, but are those increases keeping pace with the increase in real estate taxes and water and sewer and other things? So, on the legislative front, things are increasingly going against the owner's favor.
So with all that being said, Bob, why do you think that people are still aggressively buying today?
Well, I think that people really believe in New York. And if you talk to folks who have been investing for a long time, they will tell you that these political headwinds ebb and flow, they cycle, they go up and down, and at some point the pendulum will swing back. I think a number of folks who are buying believe that's the case. Secondly, we've seen great momentum in the multifamily market, in the residential market generally. A lot of residential rents that our clients are getting today are higher than they were pre-COVID. A lot of activity in the condo market is very optimistic. We're seeing upward pressure on land prices now, and that's indicative of the perspective developers have on conditions 3 or 4 years from today. So there's a lot of optimism with respect to where the market's heading. And if you look at where prices per square foot are today versus the cap rates that are being paid, we see that you can buy multifamily buildings almost at certainly less than replacement cost, but almost at what land value is. So I think price per foot is driving things. It's so interesting in the market when times are good and times are bad, the perspective on the different metrics of multifamily buildings changes. We have cap rate, gross rent multiple, price per square foot, price per unit. It seems like when times are bad, if one of those metrics is negative, an investor won't buy. When times are good, if one of those metrics is good, it is an incentive to buy. And I think we're getting to that period where a lot of these deals, the cap rate might be low, the price per unit might be high, but if that price per square foot is low enough, folks are buying because there's an inherent belief in New York. New York is the greatest city in the world. Never bet against New York. The comeback that we've made has been unbelievable, much more rapid than anyone would have expected. And to see that rents today are higher than pre-COVID rents is really remarkable, especially with the physical occupancy within office buildings that we currently have. So I think people are really making a bet on the long-term future of New York. I think the folks that are buying outside New York that historically have bought in New York are just simply geographically diversifying, which diversification is always a great investment thesis. So fortunately, there are a number of people who are there actively bidding, buying properties, and I think the future of the multifamily sector is actually very, very bright, and I would expect volume in that space to pick up very considerably as we move forward throughout the year.